Hey there, let me start with a small mystery. Every time inflation goes up, someone somewhere is smiling. Not politicians on TV, not economists on podcasts. Someone quiet. Someone you don't see. Because inflation isn't just prices going up. It's a transfer. Money doesn't vanish. It moves. And whenever money moves, there are winners. So let's meet Alice. Alice works hard, gets paid, saves a little when she can. Inflation rises. Groceries cost more. Rent creeps up. Her savings feel lighter. Alice feels like she's losing. And she is. But here's the key question. If Alice is losing, who's winning? Let's bring in Bob. Bob also lives in this economy. But Bob has debt. A lot of it. Bob has a fixed-rate mortgage. Long-term loan. Payments locked in years ago. Inflation rises. Prices go up. Wages eventually creep higher. But Bob's debt? Same number. Same monthly payment. Except now, those payments are easier to handle. Bob is paying back his loan with money that's worth less than before. Same numbers. Less pain. Bob didn't cheat. He didn't change anything. Inflation did the work for him. So one early winner of inflation? Debtors. People who borrowed before prices rose. Now let's scale Bob up. Make Bob a government. Governments have massive debt. Trillions. When inflation rises, the real value of that debt shrinks. They still owe the same number, but that number hurts less. Inflation quietly erodes debt. No vote. No announcement. Just math. That's why governments often tolerate inflation more than they admit. It makes old promises cheaper. Now let's talk about someone else. Charlie. Charlie owns assets, stocks, real estate, businesses. Inflation rises. Prices go up. But assets, they often rise with inflation. Sometimes faster. A house costs more to build. A business raises prices. Stocks reflect higher revenue. Charlie's wealth adjusts. Alice's savings do not. So asset owners often win. Not because they're smarter, but because their money is tied to things that move with inflation. Cash just sits there. And sitting still during inflation is like standing on an escalator going down. Now here's where it gets sneaky. Inflation doesn't arrive evenly. It doesn't knock on every door at once. It enters through specific channels. Government spending, banks, financial markets. The people closest to those channels see the new money first. They spend it before prices adjust. By the time inflation reaches Alice, prices have already risen. This is why inflation feels unfair, because timing matters. Early receivers win. Late receivers lose. It's like a game of musical chairs where the music gets louder, but the chairs slowly disappear. Now let's talk about wages. This is where most people hope to win. Okay, Alice thinks, prices went up, but wages will catch up. Sometimes they do, sometimes they don't. Wages are sticky. They change slowly. Prices change fast. So during inflation, workers often lose purchasing power first and recover last. Unless they have leverage, union power, scarce skills, negotiating strength. So who wins here? People who can raise prices faster than their costs. Businesses with pricing power. Companies selling things people can't easily avoid. Energy, food, housing, healthcare. They pass higher costs on. Sometimes with extra margin. Not always out of greed. Often because the system allows it. Inflation rewards pricing power. Now let's talk about savers. This one hurts. Alice saved responsibly. Cash in the bank. Low risk. Safe. Inflation rises. That cash buys less. No drama. No headline. Just erosion. Saving feels like discipline. Inflation feels like punishment. This is why inflation is especially cruel to cautious people. It rewards risk-taking and borrowing and penalizes waiting. Now here's the part that surprises people. Inflation can actually reduce inequality in very specific cases. If debts are widespread and asset ownership is broad, inflation can lift wages and shrink real debt. But in modern economies, assets are concentrated. Debt relief benefits some. Asset gains benefit fewer. So inflation often widens the gap. Now let's zoom out. Inflation isn't one thing. It's a sequence. Early inflation helps borrowers and asset owners. Late inflation hurts everyone. If inflation keeps rising, uncertainty explodes. People stop planning. Businesses hesitate. Investment slows. At that point, no one wins. Not even Bob. But before that moment, there's a window. And in that window, the winners are clear. Debtors, governments, asset owners, people close to new money. The losers, savers, fixed income earners, people paid last. And here's the most uncomfortable truth. Inflation doesn't feel like someone winning. It feels like everyone losing. Because the winners don't celebrate publicly. They just quietly feel less pressure. Lower debt burden, rising asset values, stronger balance sheets, while everyone else just feels tired, confused, like they're running harder to stay in the same place. Which is why inflation is so politically dangerous. It's invisible, complicated, hard to explain. And when people don't understand something, they assume it's rigged. Sometimes they're wrong. Sometimes, not entirely. Because inflation isn't random. It follows structure. It follows access. It follows timing. And once you understand who wins, you start seeing inflation differently. Not as a mysterious monster, but as a process that quietly rearranges the economy. Now here's the question that changes everything. If inflation creates winners and losers, and if the winners are mostly determined by where you stand in the system, then the real question isn't why is inflation happening? It's who decided this was acceptable, and who decided who would feel it first? Because once you ask that, you stop seeing inflation as an accident, and start seeing it as a choice. A choice with consequences. Consequences that don't show up evenly. And that leads us to the next uncomfortable layer. What happens when inflation becomes expected? When people stop reacting to it and start planning around it? And how that changes who keeps winning and who never really catches up. And that's when inflation stops being a surprise and starts becoming a strategy. Because once people expect inflation, they change how they behave. Alice stops saving cash. Why would she? She spends faster, buys sooner, locks in prices now instead of later. Businesses do the same. They raise prices early, not because costs already rose, but because they will. Landlords adjust rent preemptively. Companies renegotiate contracts. Investors rush into assets that hold value. Inflation becomes self-fulfilling. Now let's check back in with Bob. Bob the debtor is still winning, for now. His fixed-rate loan is shrinking in real terms. His payments feel lighter. But Bob notices something new. Interest rates are rising. New loans are expensive. Refinancing is painful. Credit tightens. Bob got lucky because of timing. Someone borrowing after inflation, different story. So inflation creates two kinds of debtors. Early debtors win. Late debtors suffer. Again. Timing. Now let's talk about governments again. Governments with debt benefit from moderate inflation. Tax revenues rise automatically. Wages go up. Nominal GDP grows. But spending commitments often lag. Debt to GDP ratios improve. On paper, things look healthier. But voters don't live on paper. They live at the grocery store. And when inflation sticks around too long, political pressure builds. So governments face a trade-off. Let inflation help their balance sheet, or stop inflation and anger markets. There is no painless option. Now here's a group people don't talk about much. People with fixed incomes, retirees, pensioners, anyone relying on predictable payment. Inflation is brutal here. Their income doesn't adjust quickly, but prices do. Every month their purchasing power shrinks, quietly, relentlessly. This is why inflation isn't just economic, it's generational. Younger workers might see wages adjust over time. Older fixed income earners often can't. So inflation shifts wealth not just between classes, but between ages. Now let's talk about businesses more closely. Not all businesses win from inflation. Small businesses struggle. They can't raise prices easily. They don't have bargaining power. Their costs rise faster than revenue. Big businesses? Different story. They have scale, brand power, pricing leverage. They can pass costs on, sometimes more than costs. So inflation tends to favor large, established players over small, fragile ones, which means inflation can reduce competition over time. Less choice, more concentration, and concentration creates more pricing power. You see the loop. Now here's where inflation gets really weird. In the early stages, inflation feels like growth. Sales are up, revenues look strong, markets feel alive. But that growth is often nominal, not real. Numbers get bigger. Value doesn't. Eventually, people notice. They're working more, earning more, but feeling poorer. That's when inflation turns from an economic issue into a social one. Trust erodes. People stop believing official numbers. Stop believing promises. Stop believing the future will be better. And once trust is gone, even the winners start losing. Asset prices become unstable. Debt becomes dangerous again. Planning becomes impossible. That's why inflation has a shelf life. Short bursts redistribute wealth quietly. Long stretches destabilize everything. So who really wins when inflation rises? In the short run, debtors. Governments with old debt. Asset owners. Businesses with pricing power. People closest to new money. In the long run, no one. Because inflation doesn't create prosperity. It rearranges it. It pulls future value into the present. And eventually the future sends the bill. This is why central banks panic when inflation expectations rise. They're not just worried about prices. They're worried about behavior. Once inflation becomes normal, it's incredibly hard to kill without causing pain. Higher unemployment, recessions, market crashes. That pain falls unevenly too. The same people who lost during inflation often lose again during the fix, which makes inflation one of the most unfair economic forces around. Not because it's intentional, but because it's asymmetric. It rewards position, timing, and access. Not effort, not virtue, not patience. Now here's the most important takeaway. Inflation is not a natural disaster. It's a result of choices. Choices about money creation, spending, debt, policy. Sometimes those choices are necessary. Sometimes they're reckless. But they always have distributional effects. Someone wins, someone loses, and the winners are rarely random. So when you hear inflation is high, don't just think prices are rising. Ask instead, who is paying less in real terms? Who is collecting more? Who got access early? Who is stuck adjusting late? Because inflation doesn't just change prices. It changes power. Quietly. Gradually. Until one day, the system feels very different from the one people thought they were living in. So, in conclusion, when inflation rises, the winners are usually those with debt, assets, pricing power, and early access to new money. The losers tend to be savers, fixed income earners, small businesses, and people paid last. Inflation isn't just an economic event. It's a redistribution mechanism. It moves purchasing power from some groups to others, often without clear consent or understanding. Understanding who benefits helps inflation make sense, not as chaos, but as a process with predictable outcomes. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.